Absolute delight to have on today's edition of the Wealth Formula Maran Govindasamy, Executive Director and co-founder of Unifi Capital. Thank you so much, Maran, for joining me on this discussion today. First question I want to ask you is, where do you think we are in the earnings cycle, and where do you think we are in the valuation cycle? Because the general sense is that across the board, because of the way money flows from domestic investors has been coming in, generally valuations across the board are fairly high. And never before did we see fund managers themselves cautioning, saying that, equities are overvalued. What is your thought? Are there enough opportunities for us to make excess returns in equities now?
See, it's actually now a fashion statement to make that equities are overvalued.
Right.
And if you had asked people even a year back, they would have felt same. And if you ask them to elaborate, they will say PE valuations are higher. This is not just India, even globally. But India is unique in markets. We may have only $5 trillion market cap as against 65 trillion plus in US. But unlike US, where 81% of the equities are owned institutionally, and something similar in Europe, in India, more than half the equities are owned by promoters.
That's right.
That's one thing unique. The second is, in India, the market cap is not a reflection of our own economy.
Right.
Something similar to US. When you say US markets are doing well, that's not a sign of US economy. More than 40-50% of the revenues of S&P 500 are non-US revenues, non-dollar revenues.
That's right.
So you may find US markets in different direction and US economy in different direction.
Right.
Similarly, in India, if you take Indian markets, for example, take large cap or mid cap or small cap or BSE 500, which is anyway 90% of India's market cap. And therefore, any analysis we make on this BSE 500 is a good representation of the total. And that anyway includes large cap, mid cap, small cap. So if you take these indices, you will find almost half of these indices in IT and financial services.
Right.
Financial services may be 35% of Sensex and Nifty.
IT will be another 12 or 13.
15, yeah. Now, IT and financial services is only 7% of GDP each. But it's half of market cap.
That's right.
If IT and financial services do badly, market may do badly, economy need not have to. The real estate and construction in our GDP is 19% of our economy. It's not even 5% of market cap.
Right.
So when we had COVID and 3 months of complete lockdown and zero activity in construction, and real estate and construction is 19% of GDP, that 19 became zero because of which GDP fell 20%. Markets did not.
Right.
Financial services were not disrupted. IT were not disrupted. Their market went up. Similarly, if you look back in 2008 and 13, from 1st January 2008 till 15th July 2013, over those 5.5 years, Indian economy actually doubled. And markets were at the same level.
Right.
Because in between you had global financial crisis, US in bad shape, Indian IT companies had to shrink the books, revenues did not grow, earnings did not grow, market valuations did not grow. Therefore, today, we should not try to make sense of our markets based on our economy. While there is a long-term correlation over 10-20 years, some people may think you can predict a next quarter GDP and try to make sense of next quarter market. It doesn't happen that way, number one. Number two, markets cannot be overgeneralized in India. The same BSE 500, more than half of the companies, PE multiples have doubled in the last 3 years. The recent peak we had was last September when Sensex crossed 86,000, small mid caps all-time high.
Right.
But the journey to the peak was not uniform. Right? Between September 21 to September 24 peak, the HDFC Bank, Kotak Bank, Bajaj Finance shareholder returns were zero.
Right.
Dabur, Marico, Lever, plus several other FMCG stocks shareholder
They're
returns
also
were zero.
flat.
Their earnings were not flat. Their earnings indeed grew, maybe single digit, maybe 10, 12, low teens.
Right.
But which over a 3-year period is meaningful earnings growth, but same price because PE multiples had shrunk. So in reality, when index was at all-time high, there was a section of stocks whose valuations, PE multiple wise, was not even half of what they were in 21. But during the same 3-year period, you had another 50-60% of the companies in BSE 500 whose earnings had indeed grew 20-25% per annum thanks to significant capex by government. The businesses that were sensitive to government spend, like defense, railways, cattle goods, infra, power, real estate. These are all the businesses where the earning growth has been spectacular and the PE expansion happened.
Yes.
So the shareholder return became exponentially high. So when you have earnings growth of 20-25% over 3 years, which is 100% in cumulatively, and you had PE expansion, the shareholder return has been exceptionally good.
Right.
But what people also don't notice is during these 3 years, no month index had moved more than 5% in any single month. You might have had higher volatility in between. Month to month, Sensex and Nifty never moved more than 5% in any single month. The term we use in our industry is the standard deviation as a measurement of volatility.
Right.
So what is the standard deviation of some of these indices in 2024? 9, 10, as against 22, which is long term. While everyone knows Nifty has delivered 14% per annum since inception, Sensex has delivered 15% per annum since inception.
Right.
Over a long period, you make 15% per annum in any index. That 15% doesn't come 15% each year. It comes with 25% volatility.
True.
But what was that volatility last 3 years? Lower than long-term average. What is the return last 3 years? Higher than long-term average. So when you have 3-4 years of higher than long-term average return at lower than long-term average volatility, usually such periods are followed by periods of lower than long-term average return or higher than long-term average volatility or a combination of both. We are just passing through that phase. But during this phase, this return and volatility is not going to be something similar to last 3 years. In reality, when markets were at peak, probably 50-60% of the companies were in bubble zone valuation.
Right.
And 15-20% of the companies are cheaper today than what they were 3 years back. And maybe 25% of the companies are fairly priced. So you can always argue markets are expensive. Looking at that 60% of the companies, I can always argue that my pool of stocks are cheaper today than what they were 3-4 years back by looking at this 15-20%. Some people may add value by saying, okay, let's not overgeneralize whole market because in the same market you have a pool of expensive stocks, a pool of cheap stocks. So we should not generalize whole market into one view. And therefore they may say large caps, mid caps, small caps. They may define the expensiveness based on the size of companies. And quite often you may have heard people saying small mid caps are expensive, large caps are not. Actually, if you take large caps, more than 35-36% of the earnings pool of large caps are at 10-12 PE, which is PSUs. And the balance 65% of the earnings pool are more than 30 PE. So index PE of 22 is hiding this extreme divergence.
Polarization between private and public.
And that polarization you find in small and mid caps. So it doesn't make any sense. Actually, it will hurt you to value companies based on size of the companies and rationalize their valuations. Instead, what is fair is to look at businesses based on those sectors' earnings growth and those sectors' PE multiple. And therefore, you will find cheap stocks in large caps as well as in small and mid caps. And you find super expensive bubble zone valuations in small mid caps, also in large caps. And therefore, let's not attempt to make sense of
Right.
whole market into one view.
Right.
There are segments in market which are cheaper today than what they were 3-4 years back,
Right.
and should deliver meaningful returns with a lesser volatility.
And what are those pockets? That 15-20% of the market that you're saying is today cheaper than last 3 years. What are those pockets?
They are cheaper than what they were 3-4 years back. Some with good reasons. And that means just because they are cheaper, we should not jump and buy.
Correct.
For example, financial services is cheaper today than what they were 3-4 years back. From 5 times price to book, they are now 2.5 times price to book.
Right.
So there are several names in NBFCs which are cheaper in valuation than as compared to what it was in 21. If they're cheaper in valuation is fact. But should we buy or not should be driven by our assessment of their future
What the future
earnings,
is going to be like.
right? There, I think India will surprise even the most optimistic guys over the next 3-4 years.
Okay.
In sectors which probably many are not looking at, right? We always have a tendency to extrapolate the recent events.
Yeah.
So you might have seen people extrapolating the last 3-4 years government capex sensitive sectors earnings growth into future, like defense, right? Some companies could do, but sector as a whole to justify this growth, even though 9 out of 10 news flow in those sectors are positive, and you talk to 100 people, it's hard to find 1 or 2 guys who are bearish about the outlook for the sector.
Right.
But we should not confuse outlook of the sector with the earning growth of that sector.
Correct.
Right? And going and buying these pool of stocks at 50p, 60p, or several names at 100p,
Yes.
as against what they were at 15-20p
Right.
3 years back, companies may do well, shareholders won't.
Right.
And therefore, you will find this 15% cheaper segment could be financial services, consumer goods, FMCGs, and some metal companies. The 25% fairly priced market could include IT, healthcare, pharma. They're not overly expensive. Maybe they're today as cheap or as expensive as they were 3-4 years back.
Right.
It is your outlook on some of these businesses in future. And in India, people tend to make assessment of a sector without realizing whether these sectors are homogeneous or heterogeneous. Maybe because our fund management industry is administered with an intent to beat an index, and index is composition of sectors.
Right.
And therefore, managers have to communicate their opinions in terms of the sectoral thing.
Right.
There are few sectors like IT where you can take a sectoral view because they are mostly homogeneous in nature. But there are several sectors in India which are extremely heterogeneous.
Right.
And in the same 3-4 years period, you may find certain NBFCs growing earnings at 20% per annum and certain NBFCs degrowing. And therefore, we should also be conscious of the fact that this is more a bottoms-up market than a market that you can take a sectoral views.
Anything like you said, for example, travel and tourism is also a sector from an economy perspective. It probably will grow. It's large in size. In stock markets, the representation is low. Anything like that even from a market's perspective looks reasonable today? Any themes that you think which can be long-term structural driver, which have long-term structural drivers in place, which you think are reasonably priced, and by taking a longer-term view, you can sort of today look at it as an entry point?
The challenge is wherever it is obvious,
It's already taken.
are not trading at fair price. Wherever it is less obvious, uncertain, are still trading cheap. For example, when I began my career in 91, if you take top 30 companies in Sensex, almost half of them, if not 2/3 of them, were steel, cement, power, textile. There was not even a single IT company and not even a single bank. The entire market cap of HDFC Limited was 160 crores, 1991. Over the next 10 years, the same steel, cement, power, textile from more than half the Sensex was not even 25% of the index. But IT pharma became almost 40-50% of the index.
Right.
And they came into the index after the growth.
Right.
But even 2001, financial services banks were hardly 6-7% of the index, which reached a peak of 40% index in 2021-22. So 10 years from now, will financial services be 40% of the index? It won't. Will it be 30% of the index? Maybe not. Can it be much less than that? Possible. That doesn't mean financial services will degrow.
Yeah.
It means there will be
Understood. Other sectors which will come to
grow
dominate.
fast. Which are those sectors? Some of them may grow, but as you rightly pointed out, they may not be consolidated in nature for them to have such large companies to have its place in index. For example, 10 years back, if someone had gone and told, you will find a hospital stock in Nifty, people would not have believed. Today we have.
Yeah.
Today we don't have a single hotel stock in index. Only recently one hotel company came into large cap index, but not in Sensex or Nifty. Maybe 10 years from now you will find. Maybe one, maybe two. So these are all sectors where it is obvious when you have 5 million, 6 million households coming from the 60 to 80 jumping above 80 and many of them jumping to above 90, you will find certain industry scale doubling and tripling over the next 5-6 years. When you have more than 10-15% in terms of volume growth in some of these businesses like entertainment, hotels, hospitals, consumer durables, home electricals, you will find many of these businesses are extremely fragmented, getting consolidated. So if you ask what is the largest hotel company's market share of the hotel industry, you will be amazed to find that it is hardly 4-5-6%.
Right.
That's the largest player.
Right.
And you will find several unorganized, small, marginal, regional players.
Right.
And you will find them fast getting consolidated. Something happened in broking industry.
Correct.
Right? In 91, we had 700 brokers in BSE.
Yeah.
Even 10 years back, there were 1,400 brokers in NSE. But what is the market share of the top 10 brokers 10 years back? Hardly 14-15%.
Correct.
What
Today
is
the
it
top
last
player?
year? 65%.
Correct.
So the industry had grown 2-3 times, but the top 5 guys have grown 20-30 times.
Right.
You will find that happening in several of these businesses. So the industry composition and index composition will undergo a dramatic change in next 5-6 years.
So you're saying inorganic growth and consolidation could be a big driver.
Absolutely.
In the large growth sectors.
Yeah.
Okay. But is that something you will pay for today? For example, let's say in hotels you have an Indian hotels or ITC hotels. Would it be fair to say that because, at what price and cost is that growth going to come in? How do you bring this into your call on stocks today?
That depends on who you mentioned right? What I do may not actually suit you.
Yeah. No,
So
you as an investor, in the sense, as an investor who is looking at stocks, I'm thinking of you right now not wearing a mutual fund hat, and as an absolute return investor who is looking at stocks to see that can I make excess returns from that perspective.
So if you like to stay within sectors where the drivers of growth are already in place.
Right.
And it is obvious to you and obvious to me and obvious to others. It is not cheap, but you still can make meaningful return. You are paying probably next 3 years, 4 years earnings to price. And if your time period is 5-10 years, you still will make decent return because sheer by the fact
that the tailwind is strong.
Is very strong, right? Both volume growth as well as you are betting on this management's capability to convert most of this growth opportunity to real business. But if you have willingness to go wrong in a way, 1 or 2, instead build a portfolio of 15-20 names where the last 3-4 years growth may be inconsistent or completely not there, and you are betting on next 5 years growth to come, and the drivers are in place to you it's more obvious to you because you have done homework,
Right.
and it is less obvious to the crowd because they haven't looked at it,
Right.
and they will look at it only when the earnings begin to percolate down to the P&L stage, which may be a year or 2 or 3 away. Those segment is actually cheaper today.
Tell us those. That is the secret sauce. Your secret sauce
So
in today's market.
it's not that the reason we don't say or we are not keen is not that we want to keep it confidential. In reality, we ourselves are not too sure, which means there is a good chance we may go wrong in few of those
No, fair
businesses.
enough. Fair enough.
But if you can spread them, as I mentioned, instead of me telling you the names of the sectors, I'm telling you what am I looking at to arrive at these names. What am I looking at? The factors which are driving like urbanization, women participation workforce. There are 4 million, 5 million households moving from non-consumer band to the consumer band. Within consumer band, so many households moving towards premiumization. And what is driving that is this. And these are all not things which are going to undergo a change 1 or 2 years from now. And this is a fairly clear 10, 12-year journey. And here, if you can find managements which have the capability to convert these opportunities to real business, and they have demonstrated that in the past, and you have had an opportunity to get to know them, invest and diversify into 15, 20 names. Be humble enough to accept you may go wrong in 1 or 2.
Right.
And don't worry about whether the portfolio is not moving in line with index for a year or 2, because these sectors will be extremely divergent from the benchmarks in today's earnings and today's PE multiple. Right? Maybe in hotels and hospitals, there may be an intersection. It may be in this list of high growth for 10, 12 years from now. It is also in the list of good recent earnings and good PE expansion recent.
Right.
But there are several sectors with the good recent earnings and high PE expansion in markets which you won't find in this list. And there are several names in this list where you are betting on great earnings growth and potential PE expansion in future, but not backed by any meaningful earnings growth in the last 3-4 years. Therefore, you won't find them in the market bucket. It is there you find opportunities.
Fair enough. So, for instance, today, based on the consumption pocket that you defined, a lot of companies, for example, in insurance, asset management businesses, some of these wealth creation kind of businesses, these will come on tops. But would you buy them? And today's valuation, does it give you comfort? Because again, there it is visible. It's long tailwind. You can't see anything that will come and disrupt them because it's low disruption kind of businesses. But does the price give you a comfort?
The same opportunity and same thing was evident 3-4 years back also. Right? But why was it that 3-4 years back insurance was such expensive? And even the largest AMC stock declined by half.
Regulatory overhang. Partly.
But partly, you are right. It is about
buying into bad news.
Not one is that certainly, but one is if you are lengthening your period of evaluation over 5-6 years, your tolerance for bad news or a regulatory handicap is only quarter to quarter short period. But if you wait for the certainty of that growth to be very clear and obvious, then the price will be expensive. Why price went a lot in insurance in that period, but it's still not delivering great returns. You are betting on future, and some of that growth got handicapped with the regulatory hindrances. And you will therefore find many of these businesses. So, for example, tomorrow, if wealth management industry gets an entry barrier, or it undergoes one more layer of regulatory oversight, is it good or bad? It may be bad for existing players in the near term, but it's great for the existing players in the long term.
If you have why do you say that?
it may be bad for the existing players in the near term because some of their practices, high fee income
Oh, you mean
sources
the
could get
competition will go
regulated.
down and the industry could
Absolutely.
consolidate?
Absolutely. Which means the time period you take to evaluate the payoffs has to be resonating with the opportunity. You can't read headlines and evaluate them good payoff over 2-3 years.
Right.
So the insurance industry payoffs should be much, much longer term than
Understood.
a wealth management company's payoffs.
So today, some of the people I speak to say that, for example, IT, today, some, 2-3 years back, people were willing to take a slightly longer term view on IT services. Today, they feel more threatened by it. They feel that, maybe I'm not so sure about the long term structural story because of AI disruption. So, which industries would you say today are you willing to take a longer term, view? You feel more confident that even if I overpay, I'm okay if I take a 5-7 year view.
See, IT is hard to crack. Maybe there are certain experts who have the skill sets to do it. But our humble view is no one knows. Because it's not that one direction it is going to take. It can lead to different. So it is a sector which is cheap, which is clear. And it's a sector which has great disclosure standards, wonderful management, high corporate governance. But no one knows the direction of growth rates.
Right.
And if you have done in the past a portfolio of investments into several beaten down sectors and knowing that few will work out, few won't, and eventually at a portfolio level they will balance out, it may suit such investors. But if you are a type of investor who is going to be narrow focused in portfolios and you would like each stock as ownership interest in a business, do you like to take ownership interest in a business of IT at this point? Price wise, okay, but earnings wise, no one knows.
Right.
But instead, if you take the second part of your question, I think it's far more obvious to bet on the domestic consumption businesses. And many of the indices that show these segments are dominant by companies like Lever, Asian Paints, Nestle's. But if you just go beyond those comfort space and look at businesses which have leadership, maybe in certain regions or certain niche products where the size of the industry was small but tend to now grow by leaps and bounds, your time period of holding may be a little longer, but the returns will more than justify that. And that segment is not as expensive today as general markets feel it to be.
Okay, so going back to this consumption mix, one of the themes that has played out really well in the past few months, at least in the last 1 year, is all these new age companies like Eternal, which have done exceptionally well. And one, of course, the managements have also become more receptive to the idea of, saying that they have to look at the P&L and they have to look at profitability. So there is some sensibility coming in there. But generally also investors have turned bullish, saying that they have established good track record. How do you look at the space? Because this is again a space which can sustain high level of growth, or high growth for a fairly long period, because these are sustainable trends, fits into the the drivers of consumption in terms of who will avail these services, also continues to be very strong. How do you take a call on such stocks?
See here, as secondary market investors, we are a bit disadvantaged. But as primary market investors, you need to have wider pool of ideas in your portfolio to justify portfolio return.
Right.
You can't take one successful example and treat that as a representation of the pool. The failure rates in these businesses are much higher.
Right.
But the success rates, even though is lower, the rate of return you can make on that success is phenomenal. So which may suit a private equity investor who makes 20 investments
Right.
and doesn't mind writing off 15 of them, and in the balance 5 he makes outsized return. That approach may not suit managers like us, and therefore investing in this space may not suit us. But in the secondary level, where some of these successful names come into the listing, the price at which they come may not justify all the uncertainties one needs to assume. And therefore, while this is a great segment to watch as a spectator, it's not a great segment to participate as a active investor.
Understood. One or two last questions. One, what is your thought around, promoter selling, and how do you view a stock when there is a block that is being sold or anything that sees sustained selling? Because this is one trend that has continued for the last 3 years, and of course, part of the reason is that as a market, our promoter holdings are high. So at some point in time, it will align with other markets which have greater institutional ownership. That is a transition that is happening in the market. But when you look at it stock by stock by stock, do you avoid such stocks? Do you look at it as an opportunity? How do you look at it?
See, promoter selling can be for 100 reasons. Promoter buying is only for 1 or 2 reasons,
Right.
strategic or financial. Selling can be for anything. Family settlements, diversification, actual liquidity requirements for something else. So many reasons. And there are several examples of promoter selling and stock doing okay thereafter. So trying to make sense of one company promoter selling with that one company's shareholder return thereafter, you will find good examples, you will find bad examples. But collective promoter activity gives a great signal. Right? So if you look at as of last financial year end, market cap close to about $5.2 trillion. Promoters hold 53%. That include 11.5% by Government of India as promoter of the PSUs, 9.5% by multinational corporations as promoters of their subsidiaries listed in India, and about 32% Indian private promoters. Why am I making these 3 distinctions? Is sometimes government doing disinvestment may also show promoter selling,
Right.
promoter stake falling.
Right.
Multinational companies selling their stakes in subsidiaries listed in India could also have an
Sure.
impact on promoter. So we should see which of these 3 categories selling.
Right.
About 10 years back, government was a willful seller. MNCs were not. MNCs were willful buyers.
Correct.
Actually, in the last 1 year, 2 years, the MNCs
Are
have begun
willful
selling.
sellers. Absolutely.
Government is trying but hasn't. The 32% Indian private promoters, as a class, is a contrarian.
Right.
Right? In COVID times, March 2020, who's the biggest buyer in market? Not government, not MNCs.
Promoters.
It is this 32% Indian private promoters. The number of companies promoters stake went up in March
Right.
quarter.
Right.
Second highest in the last 20 years.
Right.
First highest being October 2008.
Right.
When you had global financial crisis, whole world was in paralysis and index fell 60% in 10 months. Promoters were the biggest buyers because they don't
know the
consider
value
that
of
as portfolio investment. They knew the value even 1 year back or 1 year later, but they can act with conviction.
Right.
Right? So the second highest promote buying happened in March 2020. What we are now seeing is a trend. You find government wanting to sell but attempting to sell but couldn't sell much. MNC promoters selling happens. The Indian promoter selling is gaining momentum. But both the MNC promoter selling and the Indian promoter selling is not in all segments of stocks which they own. For example, have you seen any Indian promoter selling in IT? You would not have found. Why IT is cheaper
Anyway,
today?
promoter holdings are also low in IT companies.
But however low it is, but there are few IT companies where promoter holding is 60-70%,
Right, true.
and they are
true,
not sold.
True.
And there are companies where promoter holding is 10-15%, but that 10-15% is billions of dollars,
Right.
and they are not sold. At least they are not sold in the last 1-2 years as much as they sold even 5 years back. Because promoter selling is function of their assessment of the future earnings
Right.
and the valuation.
Sure, sure.
Where do you see the promoter dilution the most? In the kind of sectors where valuations are attractive,
Right.
which again is a great indicator. So the biggest sellers in market in the last several months are not FIIs, are the promoters.
Of course.
But that promoter selling you don't find in the fair side of the market and cheaper side of the market, but on the expensive side of the market. And the domestic liquidity cannot match that.
True, true.
To give a number, 53% is collective promoter stake, 10% is mutual funds. The entire equity is owned by Indian mutual funds as percentage of total India's market cap. 53% promoters, 16% FIIs, 10% mutual funds, 7% domestic institutions other than mutual funds, which is where LIC, PF, EPFO, AIFs all come in. And balance 13% is where all of us come in. Portfolio managers like us, investors like you, retail, HNIs, family offices, NRIs, corporates, all put together is 13%.
Right.
Now, this 13% category is buying directly or through portfolio managers or putting money into mutual funds which are buying the stocks. And who is meeting their demand? When you find so many, for example, this week we had one day where number of new listings were 11. Right?
Correct.
What is a sign? Is it a sign of undervaluation or overvaluation? It's a sign of overvaluation. And these IPOs that we have seen in the last 1 year, more than 70% of them are offered for sale. Which means money is going from one shareholder to the other shareholder.
Absolutely.
And that money need have to come back.
Correct.
So the promoter selling in one company is not a indicator of that company's future, but collective promoter selling is truly an indicator of the excessive valuation. And the collective promoter selling is not in all sectors. It is in certain sectors which it makes sense to skip.
So you are not a buyer in most of the IPOs, I'm presuming.
Yeah.
So you're a
We may be a buyer more as a trade, not as a true long-term investment. And it's not all IPOs are terrible. There will be few where promoters may have different reason to list.
right.
And if you find, and there are more exceptions than by rule. So in general, if someone skips all the IPOs, they may miss few opportunities, but they can save themselves from a lot of pain in future.
Sure. So I want to ask you one final question, which is, you have now, I think Unifi first fund launched in 2008. How old is it?
2001.
2001.
So we are stepping into our 25th year.
Okay, 25th year. So your track record has been phenomenal. So what is it? What do you think does it take for you to beat markets consistently? Are there any 2 or 3 principles that you can call out that have stood the test of time, irrespective of how markets go up, down, whatever it is?
Actually, our track records may look great over 25 years, but may not look great each year. It might not have looked great each year. There are years in the past where indices were up and we were down.
Yeah.
Take, for example, recent years, last year or two, we are nowhere near benchmarks. But does that mean we need to make some changes to? No, we don't. We are comfortable doing what we are. And this may suit certain types of investors. So what we focus on is the return we make over a period of time, say 5 years. If you take our journey over these years, any 5-year block, that consistency what you talked about, you may find. But you won't find that consistency in year to year.
Only. Right.
The So the answer is in the question that you asked is the time arbitrage. If you need to beat the benchmark each year, then your style of investing should reflect that, which means you should play momentum. You can't avoid sectors which are currently in vogue.
Right.
And you should focus on relative valuation.
Right.
You buy something cheap because it is cheaper as compared to the rest of the market.
Right.
But if you are taking a 5-year outlook and you are absolute return focused, but that absolute return you focus should be much more than what a benchmark can deliver over a 5-year period. See, over a 1-year period, index can do 40% or minus 20.
Yeah.
But no index does 25% per annum over 5-year period.
Right.
If that is the kind of number you have an absolute return focus, then the choices of stocks you make is influenced by that. You are not worried about what is causing stress last 1 year, or you are not going to be playing momentum or buying something because it is there is significant momentum in markets. So the only thing that we have been consistently doing now over long period, which is not actually too complex, it's simple, many investors could have done that, is if you treat stocks as ownership interest in business, instead of just treating them as piece of paper which moves up and down in value, that will bring discipline to you on when to seek money and when not to seek money, and when to actually stay away, right? And if you are a manager who follow this stocks as ownership interest in business, then you need to have a reasonable team and skill sets to evaluate those businesses. So one of the reasons you might have seen us not investing aggressively in many good new age businesses, not because we consider them as bad, but because we may not have the skill set to evaluate them.
Right.
About 10 years back, when we built a team to begin research on green investing, it was a bit ahead of time, and skill sets were not easily readily available which we can cherry pick and build a team. It was a long process. One of my clients joked that it's easy to teach finance to a chemistry guy.
Right.
But it's tough to teach chemistry to a finance guy. And we underwent that process just to understand what is green.
Right.
So it is, over the years we have built skill sets, and what is great on our side is the willingness to arbitrage on time.
Right.
When everyone focuses on 1 year, 2 year return by playing momentum, and you focus on 5-year plus return by playing value, and value not for the sake of value, but
Right.
value backed by growth that you identify with this kind of skill sets.
Right.
That I think, however institutionalized the market becomes, you still will find some niche gaps that exist.
It'll be inappropriate to ask you, what do you think of the year ahead, because you've already said you're looking at a 5-year time frame. But still, because we are doing at the time we are doing during Diwali, by next Diwali, where do you see the markets? What are the big risks that you're worried about, if at all there is?
We don't have year-to-year predictions on both at market levels, and risks don't come in a defined manner. Probably next year, the risk that would have played out next 1 year may be a risk which we don't even speak today. Right? But what is the more risk is, while there are several risk elements, but people are giving disproportionate importance to certain risk elements. That is something to be avoided. Talking so much about tariffs, talking so much about AI as risks to businesses is disproportionate to our economy and our domestic markets.
Right.
But the domestic risks um, people don't seem to focus much of their attention. And it is such risks you will find, for example, valuation risk in certain businesses can cause more harm to large number of new investors than any other risk which experts are talking.
Right.
The valuation risks in different businesses do not even take 10% of the time. The time that people take in discussing global economy risks.
Right.
And therefore, we should be conscious of what risk is relevant to us and be clear about that instead of, again, overgeneralizing the risks.
Is that the biggest risk our markets face today? Valuation risk?
Yeah.
What segment of the market? You said
The
15-20% is cheap. So by inference, could I say 80% is
15-20% is cheap. Certainly cheap by valuation. So the reason you don't buy them today is not because of valuation. Maybe because you continue to have some concerns on future earnings. But
Right.
the fact is they are cheap. That
Right.
doesn't mean 80% is expensive.
right?
Maybe about 20-25% is fairly priced. They're not cheap, but they are not expensive. They are today as cheap or as expensive as they were 3-4 years
right,
back.
Right.
15% of the market is cheaper than what they were 3 years back.
Understood. So 40.
Maybe 50-60% of the markets are in valuation, which may not generate any meaningful rate of return, could cause harm to investors who have been investing last 1 year, 2 year. And sadly, large portion of such new money is chasing those 50-60% segment.
Right.
And there, the impact you get from PE contraction is real, right?
True.
You could have bought Infosys in 2001 and broken even in 2014.
Right. Correct.
There's nothing about company or its earnings. It's about the
Yes.
price you pay.
Yes.
Till few months back, Lever was at the same price where it was in March 2020. So 8,000 index and 25,000 index means same if you are a shareholder in Lever over a 5-year period. It's not about the company. It's about the price you pay. And that is the biggest concern one should have today than any other concern that we can speak.
Right. So a lot of that money is also coming through mutual funds right now. So would you say that bulk of the money that is coming through mutual funds now is said to be disappointed? Because in the end, that's the money that is going into all those pockets and stocks.
Possible. But you can't blame mutual fund or a manager for that because what is their mandate?
To invest whatever money they get
And where?
into
In
equities.
ideas where they can beat the benchmark.
Right.
Over what time period? If more than half the investors in mutual funds holding period is less than 2 years, which is a fact,
Correct.
right? More than half of the investors in mutual funds holding period in a equity scheme
Yes.
is less than 2 years.
Yes.
So if I'm a mutual fund manager, I have to perform in 2 years. Otherwise, I'm going to lose the customer. Even if I beat the index, I won't have anyone to.
Correct.
So if that is the mandate, within that limitation, they have to invest in businesses where they can't compromise 2-year return. Today, if your focus is to beat the index this year and next year, then you have to invest in certain sectors,
Correct.
whether you like it or not. So therefore, they do what is within the dharma of the mutual funds. The investor experience could be vastly different in the coming years.
Fair enough. On that note, thank you so much. It was such a pleasure talking to you. And of course, wish you a very happy Diwali to you, to your family, and also the Unifi family. Thank you so much.
Sincerely appreciate the opportunity.
Not
Look
at all.
forward.
Thank you so
Thanks a
much.
lot.